Hello, I'm Katie St. Ors, Certified Financial Planner, Tax Strategist, and producer of The Deep Dive. Welcome to Season 3, Episode 28, and today we will do a deep dive into Form W-4, the Employee's Withholding Certificate. Okay, it looks like Elizabeth and Michael have their coffee filled and are settled in behind the microphones. So let's get going.
Welcome to the deep dive. Today we're zeroing in on something that, well, it hits every single paycheck you get. Form W-4.
That's right, the Employee's Withholding Certificate, officially.
Right, and it's basically the instruction manual for your federal income tax withholding.
Exactly. You fill this out usually when you start a new job, and it tells your employer exactly how much federal income tax to pull out of each check. It's actually pretty powerful stuff.
And that's why we're doing this deep dive, because getting this right really puts you in control, doesn't it?
It really does.
An accurate W-4 means you're, well, much less likely to get hit with a surprise tax bill or penalties come April.
And it affects your refund, too. Understanding this form helps you kind of dial that in.
Right, optimize it. So we're here to help you take charge of this often kind of overlooked part of your finances.
Yeah, and to help us out, we've looked at some key info. We've got a straightforward breakdown of what the W-4 is, its purpose, and we also checked out some insights from financial experts' YouTube videos, the ones walking through the form. So the idea today is to blend all that into something practical, something you can actually use.
Okay, let's get right into it then. What exactly is this Form W-4? What's its main job?
So simply put, the Employee's Withholding Certificate, it just tells your employer how much federal income tax to take out of your pay.
Okay.
You usually see it when you start a new job, like I said, but, and this is important, you can update it whenever your situation changes.
So it's the starting point, those instructions for how much goes to Uncle Sam during the year. Why is it so critical to get it right? What happens if you mess it up?
Well, the information you put on that form, it goes straight into your employer's payroll system. If it's accurate, then they withhold an amount that should be pretty close to what you actually owe in taxes for the year.
Okay.
And that directly impacts your tax return. If you underwithhold, you could end up owing a lot, maybe even face penalties. But if you overwithhold, you're basically giving the government an interest-free loan. You get it back as a refund, sure, but
you could have had that money in your pocket all year long.
Exactly. It's about finding that balance.
Yeah. Nobody likes those April surprises, owing money or getting a giant refund and realizing you were broke all year for no reason. Okay, so the W-4 changed a few years back, right? Let's talk through the key parts of the current version. Step 1 is personal info.
That's right. Step 1 is mandatory. Can't skip it. It asks for the basics. Your name, address, social security number.
Standard stuff.
And, crucially, your filing status. Single, married filing jointly, married filing separately, head of household, qualifying widow, that's rich. That choice makes a big difference to your taxes.
And didn't one of the sources mention something specific about the name and social security number? It seemed minor but important.
Oh yeah, that was interesting. They really stress making sure the name on your W-4 exactly matches the name on your social security card.
Why?
Apparently, if they don't match, it can cause hiccups with the IRS processing things.
Yeah.
They even give a phone number to call and check. Shows it's a detail they care about.
Huh. Good tip. Easy to miss.
Trade in your boring job for a brilliant career using Adobe Creative Cloud. Start learning now with the free trial link in the description.
Okay, let's look at step 2 then. Multiple jobs or spouse works. This isn't for everybody, right?
Correct. Step 2 is conditional. You only worry about this if you personally have more than one job at the same time.
Okay.
Or if you're married, filing jointly, and your spouse also works.
And the point here is?
The point is to make sure enough tax is withheld overall. If you have multiple income streams, or you and your spouse both work, your combined income might bump you into a higher tax bracket.
Ah, right.
And if each job just withhold based on its income alone, you could end up short. It's a super common reason people underwithhold.
Okay, so if you're in that boat, what are the ways to make sure the withholding is, accurate?
There are basically 3 ways. The first one, and it's usually the most accurate, is using the IRS Withholding Estimator.
That online tool.
Yeah, on rs.gov W4 app. It's free. You plug in your details, income, deductions, credits for all jobs, and it gives you a pretty personalized recommendation. It's like a mini checkup for your withholding.
Sounds like the gold standard, maybe.
Yeah.
What if someone doesn't want to use the online tool?
Okay, option 2 is the multiple jobs worksheet. It's actually printed right on page 3 of the W-4 form itself.
So a manual calculation.
Right. You use a table, look up income ranges, find a number. We can walk through that.
Okay. And the third option?
Option 3 is just checking a box, step 2C. And this is a big but, it's really only accurate if you have 2 jobs with similar pay.
Similar pay, got it.
And if you do use that checkbox option because you're married, both you and your spouse need to check that box on your respective W-4s. Both of you. Otherwise, it won't work right.
Okay, critical detail there. Now, you mentioned walking through the worksheet. The YouTube expert did an example, right?
Yeah.
For a married couple.
Yes. So let's use that. Say a married couple filing jointly, one spouse makes $80,000 a year, the other makes $50,000.
Okay, different incomes, so the checkbox is probably out.
Right. They'd use the multiple jobs worksheet, the one specifically for married filing jointly.
So how does that worksheet work?
It's basically a grid, a table. You find the row for the higher earners income range, the $80,000, and the column for the lower earners income range, the $50,000. You see where that row and column meet in the table.
And the number there tells you?
That number is the extra amount of tax that needs to be withheld annually because you have those 2 incomes combined. In the example, the intersection for $80K and $50 gave an annual amount of $8,340.
$8,340 extra for the whole year. Got it.
Exactly. But your employer needs to know how much extra to take out each paycheck.
Right, need to break it down.
So you take that annual number, $8,340, and you divide it by the number of pay periods you have in a year. Let's say they get paid biweekly.
So 26 paychecks a year.
Right. $8,340 divided by 26. That comes out to $320.77. The expert in the video actually suggested rounding up slightly, maybe to $321, just to be safe.
A little buffer. Makes sense. And where does that $321 figure actually go on the W-4 form?
That extra amount per paycheck goes onto step 4C. It's labeled extra withholding.
Ah, okay. So you put $321 there.
Yep. And that tells your employer, hey, in addition to the normal calculation, take out an extra $321 each payday. Covers that extra liability from the combined incomes.
That clears that up nicely. Okay, moving along. Step 3, claim dependents. Who's this for?
Step 3 is where you account for tax credits you expect to get for having dependents. But there's an income limit. This step is generally for people earning under $400,000.
Okay. And how does it work?
Well, for qualifying children under age 17, the tax credit is typically $2,000 per child.
So one kid under 17 means $2,000.
Usually, yes. And then for other dependents, maybe an older child or an elderly parent you support, the credit is generally $500 per person.
So you figure out your total credit amount based on your kids and any other dependents.
Exactly. You multiply the number of qualifying kids under 17 by $2,000, multiply the number of other dependents by $500, and add those 2 numbers together.
Okay.
That total dollar amount is what you enter on line 3 of the W-4.
And putting that number there tells the employer?
It signals that you expect these credits, which will reduce your overall tax bill. So the employer should withhold less tax from your paychecks throughout the year to account for that.
Got it. Reduces your withholding. Now, step 4 seems like a bit of a catch-all. Other adjustments. Looks like 3 parts, A, B, and C.
Yeah, the step 4 is optional, but it lets you fine-tune things even more. Step 4A is for other income.
Income not from your job?
Right, like interest, dividends, maybe retirement income that you get a 1099-R for. If you expect to have income like that, which doesn't have withholding taken out automatically, you can enter the total annual amount of that extra income here. Say you expect $3,000 in interest for the year, you'd write $3,000 on line 4A.
And that makes the employer withhold more tax?
Correct. It helps cover the tax you'll eventually owe on that other income.
Okay. Then there's 4B, deductions. What's that about?
This is if you plan to itemize your deductions instead of taking the standard deduction, and your itemized deductions will be significantly more than the standard deduction.
Like mortgage interest, state taxes, charity, that stuff.
Exactly. If you expect large itemized deductions, you can use another worksheet, the deductions worksheet on page 3, to figure out an amount to put on line 4B. This would reduce your withholding.
But you mentioned earlier the standard deduction is pretty high now.
It is. So honestly, fewer people itemize these days. Many folks will just leave 4B blank because the standard deduction works out better for them.
Makes sense.
Trade in your boring job for a brilliant career using Adobe Creative Cloud. Start learning now with the free trial link in the description.
And finally, 4C, extra withholding. We touched on this.
We did. That's where the $321 from our married couple example went.
Right.
But you can use 4C for other reasons too. If you just want more tax taken out of each paycheck, maybe you often owe money, or you just prefer a bigger refund as a forced saving, you can put any extra dollar amount you want withheld per pay period right there on line 4C.
Just a flat amount. Okay. And the final step, step 5, seems straightforward.
Very straightforward, but absolutely essential. Step 5 is sign here. You have to sign and date the form.
Why is that so critical?
Because an unsigned W-4 isn't valid. Your employer can't legally process it or use it to calculate your withholding if it's not signed and dated. It basically makes the whole thing official.
Don't forget to sign. Okay, we've broken down all the steps. Let's quickly recap the process for someone actually sitting down to fill this out.
Okay, first step, gather your info, Social Security card, maybe recent pay stubs if you have other jobs, info on dependents or deductions if that applies.
Get your ducks in a row.
Exactly. Then fill out step 1 carefully. Name, address, SSN, and crucially, pick the right filing status. Then work through steps 2, 3, and 4 if they apply to you. Use the worksheets or the IRS tool if you need help with step 2 or 4B.
Be honest with yourself about your situation.
Absolutely. Then just give it a quick review, check for typos or obvious errors. Finally, sign and date it in step 5 and hand it in to your employer, usually HR or the payroll department.
Accuracy seems to be the watchword throughout this whole thing. Once someone submits the form, are they done? Is it set it and forget it?
Definitely not. That's a really key point. Life changes.
Right.
You absolutely should think about updating your W-4 whenever something significant changes in your life, personally or financially.
Like what kind of changes?
Oh, big ones, like getting married, getting divorced, having a baby, or adopting.
Major life events.
Yeah. Or starting a new job, losing a job. Maybe your spouse's job situation changes. Even big shifts in other income, like starting to draw retirement funds, or if you know you'll have way more deductions one year. All those things can affect how much tax you should be withholding.
So ignoring those changes could lead you right back to owing money or getting that huge refund you didn't want?
Precisely. It's probably the main reason people's withholding gets out of whack over time.
And I guess we should plug that IRS tool again as something you can use anytime, not just when starting a job.
Definitely. The Withholding Estimator IRS.gov W4 app is great for doing a mid-year checkup. If you have a life change, or even just wonder if your current withholding is still on track, you can go there, plug in your latest info, and see what it recommends. It helps you adjust your W4 proactively.
Good resource to keep bookmarked. And finally, let's just clarify the employer's role in all this. They're the ones actually doing the withholding, right?
Yes, your employer takes the W4 you give them, plugs that info into their payroll software, and that system calculates how much tax to deduct based on your instructions. Then they send that withheld money to the IRS on your behalf throughout the year.
So they execute based on your directions.
Exactly. They're the mechanism, but the accuracy really starts with you filling out that W-4 correctly. It's kind of a partnership, but you're providing the essential input.
Okay, so wrapping this up, the main takeaway seems to be Form W-4 is your control panel for federal income tax withholding.
Absolutely. It's not just paperwork. It's a tool to manage your money and avoid tax headaches.
And getting it right means understanding the steps, being accurate, and crucially, updating it when life happens.
Couldn't have said it better. Don't let it sit unchanged for years if your life hasn't stayed the same.
And we definitely recommend checking out that IRS Withholding Estimator. It really can give you personalized guidance for your specific situation.
Which, brings up a final thought to leave people with. We spent this time talking about taking control of your tax withholding because that has such a big impact on your finances.
Right.
So the question is, thinking about that impact, what other parts of your financial life could maybe benefit from that same level of proactive understanding and active management?
Thanks for joining us for this deep dive.
It's been a pleasure.
We'll see you next time.
See you later.
And that brings us to the end of this episode's deep dive. I'm Katie St. Ors, executive producer of the show, and let me say thank you so much for listening. If you want more content on managing your money, personal finance, or small business, head over and find me on YouTube. The link is in the show notes. Thanks again for tuning in, and I'll catch you on the next deep dive.